So hi guys, please welcome Mr. Rahul Sharma. He's from JM Financial and he's here to help us understand trading psychology. So please feel free to ask any questions that you might have.
Yeah, thanks Kritika for having me here. It's a pleasure to be connecting with the Thinkly family and look forward to an engaging session ahead.
Thank you so for taking out the time and being here. We really appreciate it.
Pleasure is all mine.
So we already have a few people coming in. Victoria is saying, hello, sir. It's a privilege to hear from you today. Alaya is here. Hello, sir. What an interesting topic.
Yeah, thanks, Victoria. Thanks, Alaya. I can also see the questions live. I think, this is quite interactive in terms of, seeing the video and the messaging at the same time. So quite a unique platform it is, I must say.
Thank you. Really glad to hear that. So we are trying our best to keep it interactive and have connect to people with two experts so that they can ask their questions and any different, you have multiple different communities going on. So this is the business community that we're currently speaking to. So Alaya has her first question. I want to know, is it good to trade with your emotions?
Yeah. So, when it comes to, the decision making which is involved in our brains, it is, there are two types of brain that we, broadly have. One is the chimp mind, or something that is driven by our habits, something which is driven by our natural urge to take a decision into, whether it is it could be a flight response, it could be a fight response. And the second brain is the logical brain, where we take calculated decisions. So what happens in trading is, because it is involved with real money, because you could either lose money or gain in a matter of minutes or in a matter of a few hours. What happens in trading is, it is impossible to not trade without options, without emotions. So having said that, more often than not, emotions will cloud your thinking, cloud your decision making. And so the trick is to take these decisions driven by data and driven by quantifiable statistics, and keep emotions as low as possible. That is the ideal way to approach the market, approach any kind of market, be it equity market, currency market, commodity market, or anything under the sun. So emotions definitely are not do not serve the purpose when it comes to trading the markets, especially given the kind of competition that we have nowadays. The algos, and we have even AI is eventually going to come to trading in the markets as well. So it's best that we keep emotions at home when we come to trading. It's easier said than done, but that is how it should be.
Absolutely correct, sir. I mean, I think what happens as humans, we always tend to default to our emotions first. So our second question is from Victoria, sir. Sir, my question is, many people fear investing in the stock market, preferring to stay safe with banks and FDs. So what is some advice that you can give to them?
Yeah, so, in the modern day, the biggest fear is the biggest risk is not taking a risk. So, your money may be, capital may be safe when it comes to FDs, but it may not grow exponentially. It may not grow, beat inflation, as far as, you're managing your finances is concerned. So I would suggest have, at least, 3 buckets to your total investments, a safety bucket where you can park your FDs, where you can have immediate liquidity if there is any requirement. And the other 2 buckets can be, depending on the risk appetite, it could be, into, I rather call them growth buckets and dream buckets. So, on the growth bucket, you are essentially trying to beat inflation, trying to be slightly ahead of the curve. And on the dream bucket is where, probably you may have a smaller portion of your total capital, where, if your bets do play out the way that you expect them to be, then you can actually, create wealth. So the best thing to do is have this bucket approach, so that you get the best of both worlds, and also avoid not taking risk completely, especially given the kind of stage that we are, Indian markets are at this point in time. It's best to have this diversified approach.
Right, sir. I mean, I think that's really good advice, considering a lot of people do tend to fear to invest in. Like I know people who are like, especially parents of my friends who are very keen to like, ki, nahi, FDs are safe. You cannot like, mess with them, but they're very risk averse. So Selvin has another question, sir. Hello, sir. Thank you for taking the time out for this session. How can emotions like fear and greed affect a trader's decision making process?
Yeah, so these are the two core emotions that one might experience when it comes to trading. Consider this. Let us take an example of cricket. So, those who've played cricket, the tendency to hit the ball out of the park is the highest, and you want to become the hero for your team. But it involves a lot of risk. When it comes to taking the aerial shot, you might get caught out, you might get bowled, or worst case, you might have a dot ball. But the relatively safer way to take is probably take a single and keep on rotating the strike, and that is how probably you can keep the scoreboard ticking without taking further risk. So what happens is in markets is very much similar to what happens in cricket. So the temptation is there. So whenever it comes to trading, the greed will always come into play in terms of making as much money as you can, trying to go for the six or the four, or basically the boundary shot. But in that case, you might get if you try to do it on the wrong ball, you might lose your wicket. But on the contrary, there are times when probably the pitch is not so conducive for batting. It's a seaming pitch, it's a green top. You would want to take minimum risk in that scenario and play according to the situation. So we have to also be fearful at times when when the markets are not so great. So what happens is, because it is real money involved, because it is something which is so material in nature, it is definitely going to have a huge toll on your emotions. And without greed and fear, only only a computer can trade that complete elimination. But the idea is to be to keep emotions to a minimum, and take your trading decisions based on like I said, statistics, and driven by some sort of process and model that you follow.
Very valid advice, sir. So Shruti has a question. It's like, what is trading psychology basically, and why is it important in financial investment trading?
Okay, so it's like this. There would be like lakhs of participants in the market. There are so many investors. There are so many mutual funds. Everybody is looking at the same data. Most of them have access to the same information, but still a lot of people get varied results. So, for example, even if it is two twin brothers, they will not have the same results in the markets when it comes to trading or even investing for that matter. So the reason for that is the trading psychology, which is basically on what basis are you making those decisions. So if somebody is coming new to the market, the decision seems very simple, that you have to buy something, you have to sell something. But when it comes to actually getting into the game, it is also a matter of how much quantity to buy. When do we book profits? Do we book half profits? Do we book full profits? Are some of the second level decisions that a trader has to make. So what happens is, because human beings are wired emotionally, these eventually these biological mechanisms come into play, and they affect your trading outcome. So that is the reason why it is important to understand trading psychology and apply it in a way where you can at least improve your chances, improve your outcome, and be slightly better in the game as compared to what you were probably a few weeks or a few months back. So this is why it becomes very important to sort of not get carried away with like, for example, yesterday there was a note saying that there is irrational exuberance, especially in mid caps and small caps. So markets will tend to deviate from irrational exuberance to extreme pessimism. So we have to keep level headed between these two extremes. So when it is irrational exuberance, don't take additional risk. When it is extreme pessimism, avoid eliminating risk completely. It is also important to take risk. So to keep a level headed between the two, it is advisable to understand trading psychology and apply it at the same time.
Very nice, sir. That's very valid at this point. So Aaron's question is, hello, sir. Good evening. Pleasure to have you here amongst us. My question is, how do experienced traders handle loss and avoid revenge trading driven by emotions?
Okay, so there are three steps to doing this. One is to identify your edge. So what is an edge? Edge basically means that you are slightly better than the market. So even if it is like 60% accuracy, say for example, if you toss a coin, the probability is 50-50 that you will get your heads or tails. But when it comes to trading, even if you follow any basic model like charts, or it could be as simple as watching the global markets and then taking a call, or looking at what are the, say, FIIs doing, for example, in derivatives. So you have your own sort of speedometers based on which you can take your call. So first step is identifying that edge and knowing that it is slightly better than 50%. So even if it is 55%, and say the risk reward is 1:2, which is the second part, which is the money management. So point number one, any edge that you identify, give it at least 20 opportunities for the edge to play out. So for example, if you have 100 rupees to invest or 100 rupees to trade, do not put all your 100 rupees in that one idea or in that one instance. Divide it into 20 equal parts and put that money equally in 20 different instances, 20 different opportunities. And eventually what will happen is law of averages will catch up. Eventually you will get a diversified set of opportunities, and it will be a thorough test for your model, whether it is working or not. And thirdly is basically, when you've done both the things right in terms of, identifying the edge and money management, the last thing that comes is, how do you manage your emotions well? So basically, after doing everything correctly, if you do not stick to your decisions, stick to your discipline, stick to your rules, you will get carried away with the markets. And the way to do that is, be non-negotiable with your rules. Most of the times people are negotiable, or people are flexible with their rules and very rigid with their expectations. To give a very simple example, a trader will decide today I will make 2,000 rupees in the market no matter what. But what if that market is not conducive for making 2,000 rupees today? It's a very volatile day. What if there is another day where you could make 4,000 rupees instead of 2,000 rupees? So, we have to be flexible in our expectations, be rigid with our rules, and those rules have to be, hard coded in your DNA. So, you have to literally, sleep by them, eat by them, and drink by them, and only then probably you can beat the market consistently and get those returns or steady income that you are looking for from the markets.
Nice. So then now we have a question from Rohit. He's like, sir, I would like to know what are some common psychological biases that can impact trading decisions.
Okay, so some two most common biases. One is, I would say like this: people are fearful when they should be hopeful, and people are hopeful when they should be fearful. This is one bias which affects everybody. I'll give an example how. So, say you're going to a grocery store and you find your favorite, for example, whatever it is that you eat every month is on sale. So for example, your favorite shampoo, for example, say it's on sale, it's like 30% off, especially for today. So we are hardwired to lap onto such deals, where we get discounts. That is why Amazon Great Indian Sale and all the Flipkart Billion Day Sale, these are super successful. So what happens is when things become cheaper, we lap onto them. But in trading, when something becomes cheaper, generally it is best avoided. So because trading is all about following the trend. So, when you're buying something which is becoming cheaper, you're actually going against the trend. So in trading, it works the other way around, which is, something which becomes expensive is the one to bet your money on. So for example, the stock is going from 100 to 105. There's a good possibility that it goes to 110. Vis-a-vis a stock which has gone from 100 to 95, there's a good possibility that it goes to 90 because, the supply is more than the demand. So what happens is when the stock goes to 95, people turn hopeful. This will come back to 100. This will go to 110. And they keep on holding on to these losing positions, where in fact they had to be fearful. Whereas on the other way around, when the stock goes from 100 to 105 and say you are sitting on profits, instead of becoming hopeful of a more profit, which is the stock going from 105 to 110, you become fearful. What if my 5 rupees also the market takes away from me? So that is where, people get, caught. That is why markets are, they don't operate the way a grocery store, the way a DMart operates, for example. So, this is one bias that one should avoid. And the more you practice this, the more you will develop these habits, and then you can probably have a better experience with the markets.
Nice. I mean, like, this is definitely very relevant to me because it's something I've experienced on personal hand. So thank you for that. And Mehak's question is, can you explain the concept of FOMO, fear of missing out, and its relevance on trading psychology?
So it is one of the psychological loopholes that one should avoid, which is FOMO. And FOMO works on both sides. FOMO works, for I'll give an example. So markets have rallied. A lot of people, there was a data about CDSL opening the largest number of demat accounts in the month of August. Now, this has come when markets are relatively better. They did not come when markets were struggling. For example, from December until March, December last year until March this year, we had 4 months of time correction in the market. I mean, at that point in time, the demat accounts were not at life highs. But when Nifty is back to 20,000, we have this milestone number. I mean, we have this big number on new accounts open. So this is because there is FOMO, fear of missing out. So, when it comes to markets, the best thing to do is probably get in when the crowd has not come in. So this is called herd mentality. So avoid herd mentality. So this is, on FOMO is, on one side, which is, not being able to make profits. The other side of FOMO is I have made profits, but I've not made enough. So you would have made, say, for example, 20% return a month, but if your neighbor makes 30% or your colleague makes 40%, you would be like, I have not done justice to this. I should strive more. I should take more risk. I should do this. I should do that. So that side of the FOMO will make you take additional risk, make you take unwanted, risk, and expose you to a possible, drawdown. So avoid FOMO at all costs. Now, how to avoid it? So, okay, this is something which you can find it on internet, on books. Okay, many people do understand FOMO as well. How to avoid it is a difficult part. And the way I advise my clients to avoid it is basically never compare your trading journey with anybody else's. Always look at how you are doing year on year or month on month. If you are growing month on month, year on year, so what happens is the trading curve, especially once you've done your initial, the initial hurdles, it's called, you take 10,000 hours to master anything. Or it could be like, 20,000 hours as well. I don't know what the number is as per science, but, once you've navigated that difficult part, the equity curve is like very sharp. It rises very sharply up. So what people give up is, when the struggle part is going on. So be consistent. Markets are here to stay forever. Think long term. Don't think short term. And at the same time, not only avoid comparing yourself to others, but also set realistic goals. So, don't set goals where, which are unfulfillable. So, you can avoid FOMO on both the sides of the spectrum. So I hope that addresses your query.
That's great advice. I think that's applicable to all aspects of our life, in fact. Absolutely. So Arman's questions is, according to you, what are some techniques or exercises traders can practice to improve their trading?
So I wouldn't say practice makes a man perfect when it comes to trading, because if you practice the wrong thing, you can perfect the wrong thing in markets. So what I would suggest is, if you want to become a pilot, it takes about 3-4 years. If you want to become a doctor, it takes about 5 years. Trading is the only occupation which, probably you can become a trader in a weekend. You could read a book, you could attend a seminar, you could, see a YouTube video, and, you could try your hand at trading, in about 2 or 3 days. What I would suggest is, backtest your, whatever you've learned, whatever your edge you've identified, backtest it for enough period. I would say at least 3 years, if not more. See if it is working in the past. Give it a proper, a rundown in terms of, what would have been the worst case scenario. So once you say, for example, put your 10 lakhs in the market, in the last 3 years, this 10 lakhs would have gone down to say 7 lakhs. Are you comfortable losing those 3 lakhs or 30% of your capital? The answer is yes. Probably you can start doing that. The answer is no. You have to, then tweak your edge, tweak your model accordingly. So do it as if you're going to do it in a way where you are striving for infinite, or I would say, you make the game an infinite game. So if it is limited by time, if it is limited by your monetary goals, probably you might, not make it in the big league. But one way to do it is, probably design it in a way where your capital getting eliminated completely becomes out of the question, unless and until there is, a worse meltdown than COVID. Your capital does not. I mean, that is how you should design your portfolio. So that is why the bucket approach comes into play. One thing that I would quickly add is, there's this book called Intelligent Investor. In the very first two chapters, Benjamin Graham talks of managing your debt to equity ratio. So, you may start at Nifty 20,000, but don't put your 100% money in equity. Put 50% in FDs, 50% in equities. As markets go up or down, manage your debt to equity ratio accordingly. So example, say Nifty goes down by 5%. Remove 10% from your FD basket, put it to the equity basket. Market go down another 5%, put another 10% from your equity basket, from your FD basket to equity basket. And when the market reverses, say it goes up 5% above 20,000, your initiation point, you book profits in that 10% and move it back to FD. So what happens is you are all the time managing your debt to equity ratio. You don't have to take a call on stocks. You don't have to take a call on, what to buy, when to buy. You can simply do it with an index also. It works wonders. It has worked. It has stood the test of time in 2008, in 2020. So this is something that that will make your investment strategy all season proof, all weather proof.
So Karishma is asking a question. It's like, hello Rahul. When trading, one tends to talk to friends who give you tips. How do you think straight at times like these and not go with the flow?
Yeah. So tips is something a lot of people fall prey to. I would suggest do your homework. Now, where to do that homework is basically, simply go to the NSE India website. NSE India website, you will find multiple indices. So I would suggest stick to index. So for example, say Nifty 50. There's 50 stocks from the Nifty, according to market cap, these are the biggest of the big stocks that are there in the Nifty 50 index. Define your universe that you will not trade beyond these 50 stocks. So what happens is you're automatically selecting quality over news or over any tips or anything of that sort. As you gain more and more experience, the universe can widen. So from Nifty 50 you can go to Nifty 100. From Nifty 100 you can go to Nifty 200, so on. So there are multiple indexes that are there in the exchange, in the website. You can actually see the components also. What components are what index, and that way you can have your own universe, which is literally ready-made, served on platter by the exchange. On the website, and that way you will at least eliminate a lot of so-called low quality or kachra stocks, as they call it in the trading community, and at the same time help you preserve your capital as well.
Very well. I think that's something we all definitely fall prey to. So Jignesh is asking, hello sir, how do I start trading? What are the basics of trading, and how to start right when trading? And what are the habits or behaviors that we should avoid?
So, based on your question, I'm assuming you are pretty young in your career. I wouldn't suggest you to start trading unless and until, you burnt hands with a smaller capital. So don't go full-fledged into it. So for example, you may have a capital of 10 lakhs. Don't start trading with 10 lakhs. Start trading with 1 lakh rupees and see how it goes. Even if you burn that capital, you will still have 90% of your money intact. So start very small. Read a few books about trading. See, there are a lot of YouTube videos available. You can do that, or get connected with us at JM Financial in case you want us to handle your trading investing journey. And once you've, basically tested the waters, probably then you can scale up gradually. Don't do like an explosive growth, from 1 lakh to 5 lakhs to 10 lakhs. Probably incrementally, see an organic growth, 1 lakhs to 1.5 and 2 and so on. And then what will happen is after maybe a year or so, you will have enough experience as to how to tackle the markets, what works, what doesn't work for you, what makes you uncomfortable, what makes you comfortable, and probably you can have a better experience as far as the trading journey is concerned.
Yes, I think that helps a lot of our younger participants. So Nirmal is asking, many people fear making the wrong trade or wrong investment. So what is some advice that you can say to them?
Yeah, so it's just not possible to avoid a wrong trade in the market. It will happen. But what is in our control is to get out of the wrong train or the wrong bus. So if you know that you gotten into a wrong bus in the wrong direction, the earlier you get out, the better it is. So generally what we do is we recommend stop losses. We recommend an exit strategy in place even before taking the trade, so that in case if it doesn't work out as expected, at least you are limiting your downside. So, and plus, because you've divided your capital into 20 different opportunities, like I said in the very beginning, even if you end up with 5 wrong stocks out of 15, or maybe even 8 wrong stocks out of 12, and if your risk reward is more than 1:1, you will eventually make money. So, that is what the objective should be. Do not ride losers. Do not marry stocks. Never marry stocks. You can probably marry business ideas in terms of, their long-term prospects, but don't marry stocks, when it comes to trading. And, simply, when something doesn't work, exit.
Very good, sir. So Aaron has a follow-up question. It's like, what, according to you, is the ideal mindset for trading? Trading according to current market trend or trading with insight involving future predictions?
Yeah. So, trading mindset should be like this. So, you have to have a few beliefs in place. So the first belief is, anything can happen in the markets. That is the first belief that you have to ingrain in yourself. The second belief is, I don't need to know what is going to happen for me to make money. So basically, you eliminate the news part of the movement. You're not predicting any news. You're not anticipating anything in the market. Now you will ask me, then how do we sort of, be ahead of the game? So, technical analysis is one school of science. It's an art and science both, which allows us to, be slightly ahead of the curve in terms of, predicting what the next trend could be. I'm not saying news, but the trend. So the simplest or the safest strategy is to follow the trend. So be a trend follower, especially for beginners. And once you've, developed a good hang of trend following, then probably try your hand at identifying reversals. Reversals are the most rewarding ones, but the most difficult ones to predict. So start being a trend follower first, do that well, and then probably look at identifying reversals.
So there's another question. I believe this should be a final question since we're running out of time. Guys, if there's any other questions, please feel free to drop them. This will be the final questions.
Yeah.
So what are your views on currency trading? If a beginner is interested in currency trading, what would be the points to be noted while starting their journey in currency trading?
Okay, so currency trading differs from equity trading in the fact that you only have probably 4 instruments to trade with. In equities, you have about 5,000 stocks listed on the exchange. So the number of trading opportunities are also far lesser when it comes to currencies, trading the currencies. Secondly, a lot of geopolitical factors, global factors, a lot of RBI intervention is at play when it comes to trading, especially the USD IRR. So it's not a market where demand supply is completely, going on its own. It has a lot of RBI, central government intervention, central bank intervention pattern. So all the technical strategies will not exactly work the way they work in equities because of that reason. And for that, what you have to do is you have to tighten up your risk management when it comes to currency trading. So have very stringent risk management when it comes to currencies. We have very, the spreads are even smaller. So for example, I may find a stock which may move 5% in a day with reasonable probability, but finding a currency moving 5% in a day with reasonable possibility is very, rare. So, so the spreads are much smaller. But yes, the volumes are very high. Liquidity is very big. You can actually execute like a very large order with very little slippage. So it has its pros and cons, depends on, what pulls you. Apart from that, the trading, the dynamics or the physics of trading remain the same. Apart from these two, broadly, the fundamental differences that exist. Most of it is, at the end of the day, following your edge, managing your money, and sticking to your rules.
Very good, sir. I believe we are out of questions. Guys, is there the other questions? Then please feel free to drop. If not, then we'll close it out as if we are past 4:30. So, like I said, thank you so much, sir. Lovely session, great insights.
Thanks, Kritika. So, all the guests, you can feel free to follow me on Twitter, Telegram, Instagram. I mean, we are there everywhere. You can just Google Rahul Sharma, JM Financial. You will get the leads. And, it has been a pleasure doing this, video on Thinkly, and look forward to engaging with the community more often. Thanks so much for having me.
Thank you so much for being here. We really appreciate it, and you had some very amazing insights that I'm sure our community really appreciates. So thank you so much for taking the time and being here.
Most welcome. Pleasure is all mine. God bless.